Welcome to Iron Financial. This is where we forge stronger portfolios and cut right through the market weakness. Today, we are putting Darden Restaurants, that's ticker DRI, directly under the microscope. Their latest earnings report just dropped, and honestly, it's a complicated one. Now, Darden is a monster in the full-service dining world. We're talking about a massive portfolio of brands, everything from Olive Garden to the Capitol Grill. The market is scrambling right now, trying to figure out if this company's structure is built to really withstand the economic pressure we're all feeling, or if the whole blueprint is just fundamentally flawed. We're here to break it all down for you piece by piece and then give you the official Iron Financial verdict.
And that really gets us to the absolute core question of our analysis today. Is this portfolio, this huge collection of restaurant brands Darden has assembled, is it truly built to last? Are we looking at a solid foundation, something you can build on for future growth? Or are these latest numbers starting to show some pretty serious cracks in that foundation? I think that's the perfect way to frame it. Because, on the surface, you glance at some of these numbers and they look pretty solid. But when you get your tools out and you start really tapping on the walls, you have to ask yourself, what is actually holding this thing up? The headline numbers, believe me, they never tell the whole story. I'm already seeing a revenue miss, and there are some really concerning trends in their high-end brands that make me think the concrete might just be starting to crumble.
Okay, let's get right into it. We've got a lot of ground to cover, so we're going to be methodical about this. Here is our blueprint for today's analysis. First up, we're going to tackle those headline numbers. The mixed plate is we're calling it. Then we're popping the hood to do a full brand breakdown. After that, we'll look at their portfolio renovation strategy, see how they're rewarding shareholders, the builders, and what their blueprint for the future really looks like. And then, at the very end, we will deliver the Iron Financial verdict.
All right, let's start with section 1, the headline. These are the top-line numbers, right? This is the first impression, the figures that flash across all the terminals and really set the initial tone for the stock's reaction. And with Darden this quarter, it was a genuinely mixed plate. Some parts of it looked pretty appetizing, but other parts, well, they kind of left you questioning the chef.
So let's begin with the steel beam that's really holding things up this quarter, earnings per share. Darden came in and reported an adjusted EPS of $2.95. Now, what's important here is that this was perfectly, and I mean perfectly, in line with what analysts were expecting. When a company of this scale hits its earnings number right on the nose, it signals incredibly strong operational control. In a market this volatile, where you see so many companies whiffing on their targets, that kind of discipline is exactly what you want to see. It tells me that management has a really firm grip on the controls. It's the sign of a seasoned team that knows how to build profitably quarter after quarter.
Okay, but hang on a second. You're calling it a steel beam, but I see a big crack running right next to it. Look, hitting your earnings target is one thing, but how you get there is what really matters. And this is the very first crack I want to point out. While they were so busy managing costs and being disciplined, they missed on the top line. Revenue came in at $3.3 billion. The problem? The consensus on Wall Street was for $3.33 billion. That is a $30 million shortfall. So here's my question. Is this a sustainable model? Can you just keep meeting profit targets by tightening the belt while fewer and fewer dollars are actually coming in the front door? I mean, that strategy works for a little while, but eventually you simply cannot cut your way to growth. This raises some very serious questions about demand. Are consumers finally starting to pull back?
And that right there, that really is the core conflict of this entire quarter, laid out perfectly. On one side, you've got the hit, adjusted EPS landing exactly where Wall Street wanted it. That shows powerful cost control. It shows operational efficiency. It really is the mark of a well-oiled machine. But on the other side, you've got the miss, revenue falling short of expectations, which absolutely raises flags about the strength of the consumer and the overall demand for their brands. You simply can't have one without the other for long-term health. This tension is exactly why it is so critical that we dig deeper. So let's get under the hood and see which parts of this engine are really firing and which ones are sputtering.
So now we get to what I think is the most important part of the entire structure, the brand breakdown. Remember, Darden isn't just one restaurant, it's a massive portfolio. And just like in any investment portfolio, you're going to have your winners and you're going to have your laggards. We need to look under the hood and see which of these brands are the real engines of growth and which ones might just be dead weight dragging the whole company down. This is where we find out if that foundation is truly solid or if it's just being propped up by one or two support beams.
Now, at a high level, the blueprint here looks pretty solid. What you're looking at is the third quarter segment performance, and at first glance, honestly, it's just a sea of green. Sales are up across the board, from the bread and butter of Olive Garden all the way up to the high-end steakhouses. And crucially, segment profit followed right along with it. Every single one of these categories delivered more profit than it did in the same quarter last year. So on the surface, this is the picture of broad-based strength that management wants you to see. But we need to look a little closer at the growth rates to see what's really going on. And this is where the real story emerges. This chart isolates same-restaurant sales growth, which is the most critical health metric for any restaurant. And the star of the show here is just undeniable. LongHorn Steakhouse with a massive 7.2% growth. In this economy, that's not just good, that is a blowout. While other brands are out there fighting for every single customer, LongHorn is just firing on all cylinders. It is without a doubt the load-bearing wall of Darden's entire structure right now. It's doing all of the heavy lifting, and it's single-handedly pulling the entire company's average up to that respectable 4.2%. This is their star performer, no question about it.
And this right here brilliantly illustrates the point I was making about cracks in the foundation. See, those quarterly numbers can be really deceiving. So let's just zoom out for a second and look at the year-to-date performance. Olive Garden's profit, up nicely. LongHorn's, up a little bit. Other businesses strong. But just look at fine dining. That's the high-end, high-margin part of the portfolio. That includes brands like the Capital Grille and Eddie V's. Year-to-date, their segment profit is actually down from $179.6 million to $174.1 million. That's a $5.5 million drop. To me, this is a very concerning sign. It suggests that the most affluent consumers, the ones who eat at these really expensive steakhouses, might be starting to pull back on their spending. And if that high-end consumer is weakening, that's a crack that could spread through the whole structure.
That's a really fair point, and it leads us directly into our next section, portfolio renovation. You know, strong builders don't just add to a structure. They know exactly when to tear down a section that's just not working. And Darden is actively managing its portfolio, with the prime example right now being the Bahama Breeze brand. The big question is, are these smart, strategic cuts that strengthen the overall company, or are they just signs of failure?
I'd call it a strategic demolition, sure, but let's not sugarcoat what's happening here. This looks a lot like a failure to me. You're looking at a brand that is literally being dismantled. The press release mentions exploring strategic alternatives and talks about costs related to closures. And when you actually go and check the restaurant count, the numbers are stark. A year ago, there were 43 Bahama Breeze locations. Today, there are 27. They have gotten rid of 16 locations in just 12 months. That's not trimming the fat. That's a full-blown amputation. This tells me the concept fundamentally failed, and now they're just scrambling to contain the damage before it spreads. I see it completely differently. I actually see this as a sign of a disciplined and unsentimental management team, which is exactly what you should want. This isn't panic, this is a clear process. Step 1, they identified the underperforming asset. Bahama Breeze just wasn't pulling its weight. Step 2, they evaluated all their options. Step 3, they executed, closing and converting the weak locations. And now, the most crucial part, Step 4. They can reallocate all of that capital, that time, and that management focus away from a weak link and funnel it directly into their proven winners, like the red-hot LongHorn Steakhouse. This is a classic case of addition by subtraction. They are deliberately tearing down a weak part of the building so they can reinforce the core structure. That's just smart construction.
And part of any good construction project is making sure your investors, the people who funded the build in the first place, are happy. And that brings us to Section 4, rewarding the builders. Look, a company's capital allocation strategy tells you everything you need to know about its confidence in the future, and Darden is sending some very, very strong signals about how they see their own foundation.
First and foremost, let's talk about the dividend. Darden's board just declared another quarterly cash dividend of $1.50 per share. This isn't just a number on a page. It's a promise. A consistent, healthy dividend is a direct reward to shareholders for their ownership. It shows everyone that the company is generating enough cash to not only reinvest in the business, but also to hand a significant chunk of it right back to investors. It's a powerful signal of stability and management's deep confidence in their ongoing cash flow. This is the absolute bedrock of their shareholder return program.
But they're not stopping there. They also have a very robust share repurchase program. In this third quarter alone, they went out and bought back $127 million worth of their own stock, taking about 700,000 shares right out of circulation. This does two key things. First, it increases the ownership stake for all the remaining shareholders, and second, it provides support for the stock price. And they're not even close to done. They still have over $500 million authorized for future buybacks. This is another powerful tool they're using to deliver value directly to shareholders. Or is it just a way to engineer a better-looking EPS number? I mean, think about it. When you buy back shares, you reduce the share count, which automatically juices your earnings per share, even if your total net income is completely flat. With revenue growth slowing down, you have to ask yourself, is this the absolute best use of $500 million? Couldn't that money be used to, say, innovate at Olive Garden, pay down some debt, or develop a new concept that actually works, unlike the Bahama Breeze? Or is this just some financial engineering designed to mask underlying weakness in the business and keep the stock looking strong? It's a valid question.
It is a valid question, and I think the best way to answer that is to look at management's own blueprint for the future, and that's our next section. A company's guidance is its forward-looking statement of confidence. It's where they tell the market, this is where we plan to build next. So let's break down and analyze Darden's updated outlook for the full fiscal year 2026.
And this blueprint, I have to say, it looks strong. They're guiding for total sales growth of around 9.5%. That's a powerful number in this environment. They expect same restaurant sales to grow at 4.5% for the full year, which is very healthy. And they're not just growing existing stores, they're building around 70 new restaurants. They're putting their money where their mouth is, too, with up to $775 million in capital spending. And finally, it all comes down to the bottom line. A full-year EPS forecast between $10.57 and $10.67. This is a picture of a company that is planning to build, expand, and grow profitably.
Yes, an adjusted EPS forecast. And this is where we all have to be really, really careful. The headline number they want you to focus on for the quarter was that nice adjusted EPS of $2.95. But the actual reported GAAP number, the real number, was only $2.68. There's a 27-cent gap between the pretty adjusted number they advertise and the real number. And that brings us to maybe the most important question of all. What exactly are they adjusting away to make the picture look so much better? It's pretty easy to build a strong-looking house if you conveniently don't include the cost of the faulty plumbing you had to rip out.
And here they are. Here are the adjustments. This is the reconciliation. 5 cents per share is for closed restaurant and other strategic review costs. Okay. Another 16 cents, that's the biggest piece by far, is for impairment due to restaurant closures. Add in a few tax benefits, and there it is. You get your 27 cents. So let me just rephrase this whole thing. 2/3 of the adjustments that are making their earnings look so good are the direct costs of that Bahama Breeze renovation we just talked about. To me, that's not a crack. That is a gaping hole in the credibility of their headline earnings number. They are literally asking us to ignore the cost of their own failures.
You've made some very solid points. The revenue miss is real. The softness in the fine dining segment is definitely a watch item. And those adjustments to EPS, they are significant. So now it is time to put it all together. We've looked at the good, the bad, and the ugly. We've inspected the foundation. We've tapped on the walls. It is time for the iron financial verdict. Is Darden an opportunity for your portfolio, or is it a trap? Before I give our final verdict, I want to leave you with this quote from the CEO, Rick Cardenas. He said, "We continue to outperform the industry's same restaurant sales benchmark, and this quarter we widened that gap." And that quote, I think, gets to the absolute heart of the matter. Despite all the headwinds and the specific issues we've just discussed, they are fundamentally winning. They are taking market share from their competitors. This is the core thesis for the bulls. In a tough competitive environment, Darden is proving to be a best-in-class operator, and the gap between them and the rest of the industry is actually getting wider, not smaller. So here it is, the iron financial verdict. We believe Darden represents a solid foundation for growth. Yes, the skeptics' points are valid. They're absolutely valid. The revenue miss shows that nobody is immune to a softening consumer. And the year-to-date profit decline in fine dining is a definite yellow flag that needs to be monitored very closely. However, we see these as manageable cracks, not catastrophic structural failures. The incredible outsized strength of LongHorn Steakhouse is more than offsetting that weakness right now. The proactive, decisive management of the portfolio, even if it creates some ugly-looking adjustments, is a long-term positive in our book. And that combination of a strong dividend, a huge buyback program, and very confident forward-looking guidance creates a compelling case. The structure, we believe, is sound.
The foundation may be solid for now, but my final question for all of you watching is this. Darden has proven its resilience, that's true, but with the health of the consumer always in question, can its portfolio of premium brands that are a luxury, not a necessity, can they continue to carry all that weight? LongHorn had a fantastic quarter, but that can't last forever. The fine dining segment is already showing clear signs of strain. Today's solid foundation could easily become tomorrow's stress fracture if the economic environment gets worse. So keep your hard hats on and remain vigilant.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.